studying your last two. I swim med when they turned in. The styren down to mute. And can learn the pole that Sunky died.
Dividends are another common way for an owner-manager to take money out of a corporation. Unlike salary, which is paid because the owner works for the business, a dividend is paid because the owner holds shares in the corporation. In other words, the payment is made in the owner's role as a shareholder, not as an employee. A dividend represents a distribution of the corporation's profits to its shareholders. Before a dividend can be paid, the corporation must first earn a profit and pay any applicable corporate income tax. Only the remaining after-tax profits are available to be distributed as dividends. This is one of the fundamental differences between salary and dividends. A salary is processed through payroll, reported on a T4 slip, and paid as employment income. A dividend, on the other hand, is paid directly from the corporation's after-tax profits, does not go through payroll, and is reported on a T5 slip instead. There are also certain conditions that must be met before dividends can be paid. The recipient must be a shareholder of the corporation. The corporation must have sufficient after-tax profits or retained earnings available for distribution, and the board of directors must formally approve the dividend before it is paid. Unlike salary, dividends are generally paid according to share ownership rather than the amount of work performed. The overall process is straightforward. The corporation earns a profit, pays corporate income tax, retains the remaining after-tax earnings, declares a dividend through a board resolution, and finally distributes that dividend to its shareholders. The key idea to remember is that dividends are not a payroll payment. They are a distribution of corporate profits to shareholders. Because of this, dividends follow a completely different set of tax and reporting rules than salaries, making them an important alternative method of compensating owner-managers. When a corporation chooses to compensate its shareholders through dividends, the payment follows a process that is very different from payroll. There are no paychecks, no payroll deductions, and no monthly payroll remittances. Instead, the dividend payment begins only after the corporation has earned a profit. The first step is for the business to generate taxable income during the year. Like any corporation, it must then calculate and pay corporate income tax on those profits. Once the taxes have been paid, the remaining after-tax earnings become part of the corporation's retained earnings and may be available for distribution to shareholders. Before any money can be distributed, the board of directors must formally approve the dividend. This is done by passing a board resolution that specifies the amount of the dividend and the shareholders who are entitled to receive it. Without this formal declaration, the payment is not considered a valid dividend. Once the dividend has been declared, the corporation pays the shareholders according to their share ownership. Unlike salary, the payment does not go through payroll. There are no payroll deductions, no CPP contributions, and no employment insurance premiums. The shareholder simply receives the dividend payment directly from the corporation. At the end of the year, instead of issuing a T4 slip, the corporation prepares a T5 slip. The T5 reports the dividends that were paid during the year and is provided both to the shareholder and to the Canada Revenue Agency. The shareholder then reports those dividends on their personal income tax return. Although dividends avoid payroll administration, they are not tax-free. They are taxed under a different set of rules using Canada's dividend tax system, which includes the dividend gross-up and dividend tax credit. These rules are designed to help achieve tax integration between the corporation and the shareholder. The key point to remember is that dividends are paid from after-tax corporate profits, not through payroll. The process is straightforward. The corporation earns a profit, pays corporate tax. The board declares a dividend. The shareholder receives the payment, and the corporation reports it on a T5 slip. Understanding this flow is essential because it explains why dividends are treated differently from salaries under Canadian tax law. Dividends are popular among many owner-managers because they offer a simple and flexible way to take money out of a corporation. However, like every compensation method, dividends come with both advantages and limitations. Understanding these trade-offs is essential when deciding how an owner should be compensated. One of the biggest advantages of dividends is that they do not require payroll administration. There is no need to process payroll, calculate payroll deductions, or make monthly payroll remittances to the Canada Revenue Agency. This makes dividends much easier to administer than salaries. Another advantage is that there are no Canada Pension Plan, or CPP, contributions. Since dividends are not employment income, neither the corporation nor the shareholder is required to contribute to CPP on these payments. Dividends also offer flexibility because they can generally be declared whenever the corporation has sufficient after-tax profits and the directors approve the payment. However, dividends also have important limitations. Unlike salary, dividends are not deductible to the corporation. This means they do not reduce the corporation's taxable income. Dividends also do not create RRSP contribution room because they are not considered earned income. In addition, since no CPP contributions are made, receiving only dividends does not build future CPP retirement benefits. Another important limitation is that dividends can only be paid if the corporation has sufficient after-tax profits or retained earnings available for distribution. A corporation cannot simply declare dividends whenever it wants if those profits do not exist. This is why two corporations with very similar businesses may choose completely different compensation strategies. One owner may prefer salary because they want RRSP contribution room and CPP benefits. Another owner may prefer dividends because they value administrative simplicity and flexibility. In many cases, experienced tax advisors recommend using a combination of salary and dividends to achieve the best overall tax and financial outcome. The key takeaway is that dividends compensate an owner because they are a shareholder, not because they are an employee. They eliminate payroll administration and CPP contributions, but they also give up certain benefits that come with salary. Choosing between salary and dividends is not about finding one method that is always better. It's about selecting the combination that best supports the owner's tax position, retirement planning, cash flow needs, and long-term financial goals.